Good morning, everyone. Today I'll be presenting on the rural and microfinance, focusing specifically on systemic risk, governance, and sustainability challenges that are in the sector. Microfinance plays a crucial role in financial inclusion, but it also faces structural, operational, and regulatory risk. Through these cases discussions, we will understand where things go wrong and how sustainability can be achieved. What is microfinance? Let's begin with the basics. Microfinance refers to provisions of small loans, savings, services, insurance, and other financial products to low income or undeserved population who do not have access to traditional banking. In India, microfinance institutions are regulated by the Reserve Bank of India (RBI). The three major objectives of microfinance are poverty alleviation, women empowerment, and financial inclusion. It is not just about lending money, it is about enabling economic participation. Over the case study one, over indebtedness and borrower distress. Here's how it typically happens. Multiple MFIs lends to the same borrower. The borrower takes new loans to repay old loans. Gradually, a debt spiral begins. Why does this occur? Weak credit information sharing, competitive pressure among MFIs, low financial literacy among borrowers. The impact: rising NPAs, portfolio instability, reputational damage, regulatory intervention. This shows that aggressive growth without proper credit checks can destabilize the entire sector. Case study 2: high operational cost and interest pressure. Microfinance is structurally expensive. Why? First, the doorstep service model. Field officers travel weekly to collect repayments. Second, loan sizes are very small. Monitoring costs are high relative to revenue per loan. The results: higher interest rates. This often leads to public criticism and politically scrutiny. The key takeaway here is microfinance is expensive by design, not necessarily by exploitation. Case study 3: credit risk and income volatility. Credit risk in microfinance is inherently high. Why? There is no physical collateral. Loans rely on social collateral, meaning peer pressure within groups. Also, borrowers are often dependent on agriculture or informal employment. Income is seasonal and volatile. The biggest problem occurs during the systemic shocks like droughts or pandemics. When the whole community suffers, peer pressure fails. This creates correlated risk and higher defaults. Case study 4: regulatory and compliance pressure. Regulation is necessary to prevent overlending, cap excessive pricing, ensure transparency, protect borrowers. However, compliance increases cost. MFIs need skilled staff, reporting systems, and internal controls. Too much regulation can reduce flexibility, too little regulation can cause crisis. So the change is balance, protection with sustainability. Case study 5 and 6: governance and mission drift. This slide addresses governance risk. Governance failures include founder dominance, weak board oversight, poor risk management, and formal controls. Then we have mission drift. Originally, MFIs aim to serve the poorest borrowers, but under profit pressure, they may shift towards safer, urban or higher income clients. This shift reduces social impact. Strong broad oversight ensures strategic clarity, risk monitoring, investor confidence, long-term sustainability. Governance determines whether microfinance remains socially responsible or becomes purely commercial. Case study 7, funding constraints and capital dependence. MFIs face funding challenges, most dependent heavily on bank loans. Many cannot mobilize public deposits. This creates capital dependence. When interest rate rise, cost of funds increases, margin shrinks, borrower pricing pressure increases. So MFIs are highly sensitive to monetary policy and funding conditions. Case study 8 and 9, HR external shocks. This slide focuses on human and environmental risk. HR challenges include high workload, strict recovery targets, emotional stress, high attrition. Ethical risk emerge when recovery practices become harsh. Technological gaps are also significant. Digital illiteracy, poor connectivity, and cyber risks, external shock life, monsoon failure, economic slowdown, pandemic all create correlated default risk. Microfinance operates in highly vulnerable ecosystems. Um, Conclusion: sustainable microfinance requires balance. Microfinance sustainability depends on four pillars: ethical leadership, fair lending practices, strong governance, accountability and oversight, smart regulation, proportionate rules, financial discipline, prudent risk management. These there are stakeholders tensions. Borrower want affordable credit. MFIs need sustainability. Banks want safe portfolio, and regulators want stability. Microfinance is a powerful tool for inclusion and social entrepreneurship, but it is exposed to systemic risk. Success lies in balancing profitability with social responsibility.